Hello, everyone. Thank you for joining us for our presentation, Forecasting Beer Production Using Time Series Analysis, presented by current faculty director of the MS of Business Analytics program at Santa Clara University, Dan Trepanier, in collaboration with Ivy Exec. My name is Andrew Valdez, and I'm part of the team here at Ivy Exec, and it will be my pleasure to moderate today's session. Before we begin, I have a few brief housekeeping items for our audience. First, all attendees are currently in listen-only mode. However, we do encourage you to engage in the session by asking questions to our presenter, which you can do by using the question box in your GoToWebinar control panel. We'll be doing a formal Q&A session in the last 10 to 15 minutes of the presentation, so we do encourage questions throughout the presentation. Additionally, we are recording today's session, so you can look forward to receiving a copy of the recording via email in the coming days. And now, I'd like to introduce you to today's presenter, Dan. He was most recently CEO of Shambhala, an electronic market maker in US equities, where he led Shambhala's pivot from a hardware fabless semiconductor vendor to a proprietary trading firm. He built the team for the new business model, grew the revenue, and ultimately sold the firm to Final, an Israel-based trading firm. Prior to Shambhala, Dan was the founder of Quake Technologies, a semiconductor firm that led to the development of 10G Ethernet networking technology. He then sold the firm after growing it to profitability. Dan received a BS from Queen's University and an MBA from NYU, and it'll be my pleasure now to hand it off. Welcome, Dan.
Great, thank you, Andrew. All right, well, welcome everyone, and we're going to be playing with data today. And the first step in that is to try and figure out how to answer, or what's the normal approach for dealing with data exploration. And so typically you'd start with a problem, then you'd go out and gather some data to answer the question that you're trying to answer. You might go back once you've gathered the data and modify your problem a little bit. But typically you'll just start with one set of data, then run some analysis on it. And once you've run that analysis, you might say, oh, well, I could actually use more data to help my analysis, and then go back and gather more data. And then you might go to developing a model, and you might like that model or not. And if you don't, you might do more analysis, you might gather more data, you might change the problem that you're trying to address, and then ultimately you'll get to some sort of conclusion that's hopefully taking you closer to answering the question that you initially posed. And so today's problem is going to be forecasting Australian beer production. Why beer production? Well, just because there happens to be some very nice data sets for us to play with that'll help us walk through exploratory data analysis. So let's start with maybe a couple of questions, but we'll level set by describing the data. So we have data that goes from 1956 to 1995, and we'll try to understand the nature of beer consumption in Australia during this time frame. The idea will be to build a model to predict beer consumption over a 3-year horizon. So we'll see if we can develop a pretty good forecasting model. But let's start by thinking through expectations. Do we think beer production was increasing or decreasing over this time frame? And what variables might impact beer production? So let's start with the first question. We'll run a quick poll. There's no right or wrong answer, but the idea is to see what do people think in general. And I would encourage you not to go to the web and look up the answer first, but just try and answer the question based on your gut feel. What happens to beer consumption from 1956 to 1995? Andrew, you can maybe run the poll at this point.
Yeah, absolutely. And to our attendees, I've now just launched the poll. So what happened to beer production in Australia from 1956 to 1995? And you may select one of the following answers. I'll keep it open for another 15 seconds. To our attendees, please respond to the poll. And a quick reminder to our attendees to also post your questions to Dan in the chat box for our Q&A session at the end. And I will now close the poll. And I will now share the results, Dan, and it looks like 72% have said increased, 7% have said decrease, 6% have responded remain approximately the same, and 15% have said go up and down.
All right, that's great. Well, like I said, there's no right or wrong answer, but it's always good to understand what our biases are before we go into this kind of analysis, and then we play with the data and see what actually comes out of it. All right, so most of you think it's going to be increasing over time. Now let's look at why you might be thinking that. So the next poll question is going to be, what factors impact beer production? Would it be demographics, things like population growth, age, health consciousness, availability of substitutes, wine, distilled alcohol products, other products, exports? So would Australia be a net exporter of beer and as such have increased demand for beer or something like that over time? Supply chain issues, availability of raw materials to make the beer, or economic cycles. So I'd love to hear your thoughts on that. So let's run another poll, Andrew.
Okay, I just launched the second poll. To our attendees, please respond to what factors impact beer production. Just a reminder to our attendees to please respond to the quick poll. You may select one of the following answers. I'll keep it open for another 15 seconds. All right, and I will now close the poll, and I will now share the results, Dan. It looks like 44% have responded with demographics, 24% have responded substitutes, 6% have responded exports, 18% have responded supply chain, and 8% have responded economic cycles.
That's great. That's great. I guess we get to see the wisdom of crowds at work here today, which is great. Okay, so let's play with the data and see what we actually get. So first off, this class or this lecture is about doing time series analysis, and we're going to do this in Python. And so specifically, I'm using Python 3.7, which is one of the more recent versions of Python. And I'm using a number of packages that are available within Python. So things like NumPy, Jupyter Notebook is the environment in which I'm coding right now, Pandas, Matplotlib, and Seaborn, which are graphing tools, stats models, which is a whole statistical library that helps us with time series analysis, and sklearn for regression analysis. And so as code, this is what it looks like. And here you get to see how I import all of the necessary packages into the Jupyter Notebook. All right, so let's load and plot the data. So that's step one. So here you'll see I have a CSV file called Australian Monthly Beer Production.csv, and I can parse the dates in the file so that they're accepted as standard date formats within my Python code. And if we plot the data, we can see that the trend is actually going up. So most of you were right. So it looks like beer production actually went up over time. But it looks like over the last 20-year period, it may have flattened out a little bit. And then if we look at the lines, it looks like they're bobbing up and down. It's kind of an interesting pattern. So we'll have to try and dig into that and try and understand it better, because that may or may not meet our expectations. But let's see if we can zoom in a little bit and get a better view of what might be happening. So just as a step back though, when we're describing data, there's three major aspects of a data set that we want to think about. So one is trend. So what's the long-term direction? And in this case, long-term means multi-year. A second aspect is seasonality. What's the impacts within 1 year? So are we seeing that some periods of the year have more production, while other periods of the year have less production? And then another effect is cyclicality. So if there's periods where during a recession, people might consume more or less beer, and then during good economic times, they might consume more or less beer. And these economic cycles can last multiple years. So we're going to be looking for those three effects. So let's zoom into this a little bit. So here I've plotted the last 5 years of the time period. Actually, it's the beginning 5 years. So let's take a look at it more closely here. So it's the beginning 5 years. So it starts in 1956. Then it has a big white line at the end of 1956 to show the beginning of 1957. And then a big white line in 1958 to show the start of 1958, then 1959 and 1960. And what we notice in this curve is that there's pretty decent consumption in January, February, March, and then it starts to drop off and it goes down in June, and then it comes back up again in the second half of the year and peaks around December, and then it repeats again the following year. And then it tends to repeat again the following year, and so on. So this jagged pattern that we saw earlier seems to have some seasonality to it. So let's do a quick little poll question to see what factors drive beer production seasonality.
Yeah, all right. Well, let's take a poll. I've just now launched the poll for our attendees. What factors drive beer production seasonality? And I'll keep it open for another 20 seconds. Please select one of the following answers. All right, I will now close the poll and I will now share the results. Dan, it looks like 7% have responded with temperature, that people like beer when it's cold outside. 61% have responded temperature, people like beer when it's hot outside. 23% have responded holidays, people drink more during the holidays. And 9% have responded availability of raw materials, brewers can produce when they can.
All right. So these are great answers. So let's take a step back and look at our data and see how this lines up. So here we have peak production in January, February, then it troughs, and then it peaks again in November and December. Strange, isn't it? Because it's the exact opposite of what our wise crowd suggested. Or is it? So there's a little gotcha here, which is it's Australia. And so in the Southern Hemisphere, their winter is in June and their summer is in December and January. And so that's the effect that we're seeing. And the fact that our poll responders also said that holidays is a time where people would drink beer means that we got it like 85% right, more or less, which is great. So clearly our crowd is very wise. All right, so the answer then is Australian beer data suggests that we have a peak during the Australian summer and a trough during the winter. But let's try to understand it better. So what I did here is I took the raw data by month and organized it by month. And so if you look at every month of the year, so January, February, March, and all the way through December, I've taken every record in our data set and separated out all of the January data and put it in one line, and took all of the February data and put it in another line, and so on. And it looks a little bit messy. So what we'll do is look at the top line, which is something like December, and then we'll look at the lowest line in the plot, which is June, and just look at those two lines and see if we can get a sense of what the envelope looks like during the peak month and the envelope during the lowest consumption month. And if we look at that, the trend effects and the cyclicality comes out a little bit more clearly. So we can see that during the peak month, the consumption seems to be increasing for most of this period, but then in the latter half, it just flattens out. And the same effect is also present during the slowest consumption month, where we see steady increase, but then flattening out during the last half of the data. So why might that be? Well, we don't know yet, but as we did with the poll questions, it's always good to have a running hypothesis in the back of your head and think about, well, what are some of the effects that might drive this and that might have an impact on this? but let's keep exploring a little bit for now. So in this particular plot, this is a box and whisker plot. I'm showing what the range of values is for the entire data set. So this is from 1956 to the 1995. So it's a full 40-year period. And for every month, I'm showing what's the minimum consumption observed, what's the maximum consumption observed, and what's the quartiles and the median in the form of a box and whisker plot. And I can see that January has a pretty good range. I can see the effect of seasonality where it drops a little bit by the middle of the year, and I can see where it peaks again near the end of the year. Another way to show the same kind of data is to use a violin plot. And a violin plot is where you have a probability density function, so a distribution function over this full time period. And so it gives you a better color than a box and whisker plot about where the peaks are within the monthly distributions. But if you think about this, it sort of suggests that you have lots of consumption in January, more in December, November's kind of similar, and December and February is lower. But are all months created equal? Some months have 28 days, or one month has 28 days, some months have 30 days, some months have 31 days. So let's see if we can correct for that. I call this being meticulous. So if we correct for this, we can have a metric that we call days per month, and we can look at what the actual daily production would be. And so we'll measure the daily consumption for each month. And so for a month of January, this means that we took the raw data and divided it by 31. For February, we divided it by 28 or 29, depending on whether we're looking at a leap year or not, and so on. And what we see is that November and December actually look very similar to each other. So come the springtime, or just a little bit ahead of the start of official summer, beer production actually increases a little bit. And because we're looking at production here, it's conceivable that the producers are trying to just stack the shelves ahead of the holidays. And so there's potentially that sort of effect going on as well. But if we zoom out and look at the trend, we already did the exercise of looking at the trend based on the peak month and based on the trough month. But another method would be to do a moving average smoothing. And in a moving average, you're taking the sum of the last 12 months of consumption and dividing by 12, and then doing that step by step as you go through the data. So let's see what that would look like. So in this case, I took the daily consumption of beer and I ran a rolling mean of that data, which produces the red line. And in gray, I showed the original daily production data. And if you look at this line, it's quite telling that it's the exact same type of shape, but it's quite telling that there's significant growth, and again, it flattens out. So looking at the trend in raw form, we can see this picture a little bit more clearly, and it becomes less noisy than when we have the raw data on the plot. And I'd like to just make the point at this stage that visualization is an important part of playing with data, and that's how the human brain can interpret what's actually going on with the data. So I encourage you, when you're playing with data, to play with a lot of visualization. So let's think about other effects that could be impacting beer consumption. And if we go back to our original survey, it looks like 44% of you thought that demographics would play a significant role and substitutes would be next. And we happen to have a lot of demographic data, so let's go play with that and see if we can merge the two. And so this was the original poll question that I posed. And let's see if we can get the actual Australian population. So I was able to find the Australian population data on the web, and this is what it actually looks like. So it includes the average population for every year. The tail of the data ends in 2011, so it's after our 1995, and actually starts in the early 1900s. So we have way more data than we need for today's exercise. But we for sure have average population year by year, which is great. And if we plot the population growth data, which starts in 1900 and goes to 2011, we can see that it's a little bit flatter in the beginning, and then the slope is steadily increasing over time, which suggests that this is a geometric growth process. And a geometric growth process means that it would increase by a certain percentage every year. And if something looks like a hockey stick where it starts flat and gets steeper and steeper, it's probably a geometric growth process. Sometimes people call it exponential growth. And when you have that sort of effect, it becomes fairly easy to correct for the difficult prediction of a curvy effect by just taking the log of the data. And when you take the log of the data, miraculously, it becomes something close to a straight line. In this case, it's not exactly, but it's pretty close. And certainly for short periods of time, so within a decade or a certain decade and the one right after, this approximation would hold if we were trying to extrapolate or predict population growth based on a log of the data and using a linear model. All right, so now we have the Australian population data. And what I do with this little snippet of code is I merge the population data with the beer production data. And the first step in doing this is just building a little dictionary here that says for a given year, what's the average population? And it goes all the way through starting in before 1900, or it starts in 1900, but we see that we cover the years that we're interested in, so 55, 56, and going into the 1995, 1996 period. And we have data for every one of these years, which is, of course, what we want to do. And then I put in a quick little statement here so that it figures out what the population is for every one of these months. And there's a little strangeness in this because I'm just assuming that the average population is the number for all 12 months of a given year, okay? And I did not put a correction where the start month is a little bit less and the last month is a little bit more. But that's certainly a correction that if you were hired as a data scientist within a beer company, it's a correction that you'd probably want to put in place. And so once we're armed with this data, it becomes simple math to say, well, what's our daily per capita beer consumption? So per head, what's our beer consumption or production, sorry. And so in this case, if we look at the daily number divided by the population for every year, then we get a daily per capita, and we can plot that. And here we see a different shape. So here we see that it's flattish at the beginning, it increases in the middle, and then trends downward, comes up a little bit maybe, and then trends downward again. So this effect is somewhat unexpected. But let's take a look as to how the per capita compares with overall production. And so if we plot the two side by side, so on the top plot, I have the daily production, not adjusted by population. On the bottom plot, I have the daily production adjusted for population. And the curves look completely different from one another. And these are the moving averages, right? So it's the 12-month rolling mean of the data points. And so in effect, what we're seeing is that over this time period, the beer production per head actually dropped. A bit of a surprise. So let's check in on our story. So we see beer consumption increasing in the summer, We see consumption or production peaking in the early 80s and leveling off since. And then the per capita consumption and production has been declining since. Okay, that seems to be what's going on. So let's go to the next step, which would be forecasting. So in this case, we're actually building a model to make a forecast. And we're going to forecast two things. We're going to forecast population increase, which should be a fairly easy exercise. And then we're going to forecast the per capita beer consumption. And then we're going to mix the two together to produce a forecast of total beer production. All right. And so in terms of where we sit in our process of exploratory data analysis, what we've done so far is we've identified a problem. We gathered the initial beer data, and then we did a little bit of analysis on it. And then we concluded that maybe we should try and understand the components of what's going on. And so we pulled demographic population data. So we went back to this step, did a little bit more analysis and comparison. And now we're going to build a model, understanding full well that we might decide to incorporate more data later. We might decide we want to include substitutes, or we might decide we want to include exports. And if we were to do that, we would take multiple steps back, go gather the data we want, do a little bit more analysis, and look at our model again. And we can keep doing this for a long, long time. And that's why data science is a job. And that's why people spend time doing these things. And it's a fun detective work, because you're always trying to understand what's actually going on with this data. Why is this the case? And you're really a sleuth trying to get to the right answer. Okay, so let's build our model. So first off, one important concept in data science is in-sample and out-of-sample data. Well, what does that mean? In-sample means that it's data that you're using to construct your model. And once you've used that data, you've extracted all the information out of it in order to produce a model that gives you a forecast. Once you've extracted the information out of it, you want to see, is this model good enough to work on data that I've never seen before? And the data we've never seen would be called out-of-sample data. All right, and so it's just a convention of how people talk about this data. People might call it something else. They might call it holdout data, or they might call it learning data. They might call it evaluation data. So there could be different names for it, but personally, I like in-sample and out-of-sample, and it makes it very clear for other data scientists to understand what you're doing. Okay, so again, let's look at the exercise we're going to run. So number one, we're going to do a prediction of the Australian population. And then we're going to, number two, do a prediction of the production per capita. And then we'll bring those two forecasts together and see if we can forecast total Australian beer production for the month. Okay, so we can run a simple linear regression to predict the log of the population. So what's a linear regression? Well, in this case, we're going to use an ordinary least square regression. And with an ordinary least square regression, what we do is we take all of the data points that would fit a line and minimize the root mean square error, so the error in fitting that line to a given slope and intercept. And that's going to be the first exercise. Once we've produced a forecast of the log population, then we can raise this forecast or this estimate by E, or E to the predicted value. And that's going to give us in the units of origin, so in population count or people count, the estimate for the population. All right, so let's see if we can build this model. So you'll notice that in looking at the population data, that we have this staircase pattern. Well, why might that be? So we have a staircase that goes from 1956 all the way to 1995. And some steps seem bigger than others. And there's different sections to this plot. Wonder why that is. Oh yeah, remember earlier, I said that I just took the same average population for the whole year. So that's why we have the staircase pattern. And that's one of the things that I suggested that if you had this as a real job, you might want to taper the population so that every month was a smoother increase over the next month or the prior month, sorry. You also might notice that the curve has two distinct segments. So the line has two segments here. So there's a segment that has a particular slope, there's a big step up, and then there's a slightly different slope for this segment. So what might that be related to? Well, potentially it's immigration policy. So there's periods where immigrants were coming in at a higher rate, and then the government just, or the people elected a government that was not as favorable to immigration. And they could have said, well, listen, the population's been growing too fast. We should slow down our immigration rates. And then you'd see a different slope for that time period. And then it actually, to my eye, looks like there might be a little bit of an increase here. So potentially there's like three different sets of governments or sets of policies anyway that have been afoot during this time period. So those are just observations from looking at the data. And of course, these are hypotheses. They're not proven, but it's always good to have a story in your head. And so I'm always trying to build that story. Okay, and so the Python module here is nicely put together to allow you to split your data set into your training or Insample data and into your test data. So this function here gives you the training data and the test data. And I can say that I want to hold out 20% of my data for testing. And one important function here is to not shuffle the data, but I won't go too much into that for today's lecture. Okay, so if we look then at this data, what I chose to do was to look back over a 60-month period at any point in time. So 60 months is 12 times 5, or 5 years of data. And if I look back over a 60-month period and make a prediction of what's going to happen over the next time frame, so potentially 3 years, based on what happened over the last 5 years, I'm expecting to get a decent model. So this is, again, predicting the log population. So you'll see these units are strange units, like 16.52, 16.54, 56, and so on to 16.60. And then here we have the counts of the months, but let's see if we can reconcile that a little bit and see how does it perform out of sample. And so here we're looking at each one of these lines is a year. So it's like a few months in the first year, a full year, 2, 3, 4, 5, 6, 7, 8, and 9. So it's covering an 8 to 9 year period. And we can see that we're a little bit off for some stretch of time, and then it comes back in and the error gets reduced again. And so no model's ever going to be perfect. And if we had more features that we could put into the program or into the model, things like what type of government is it? Are they pro or anti-immigration? And things like that. And we could predict what type of government will be in place at different points in time, then maybe we could build a more educated model. But for now, this is a reasonable model for us to be working with, especially since we see that it's good in the first period of time, it's good in the last period of time, and just has some sort of error in the middle. And the next model that we want to build is going to be based on a time series analysis technique. And time series analysis is a forecasting methodology that builds models to predict future values based on previously observed values. And the technique counts on the data being sampled evenly in time, and it assumes that the time series is stationary, and it uses statistical techniques to predict the residuals. So stationary is probably the one big word that's new here, and residuals is probably a new word. So let's talk about both of those. So stationary means that the statistical properties of the data are consistent over time. And the two main statistical properties we're going to be looking at are the mean and variance of the data. So if we're looking at time series data, we just want to make sure that if there's any kind of pattern in the data that it doesn't like increase or decrease in a meaningful way over time. So we want to know that the mean for the data is going to be consistent over time, and the variance of the data is going to be consistent over time, and that there's no autocorrelation of one particular point to the prior point. So there's no, that's the third statistical property that we care about. So constant mean, constant variance, and no autocorrelation to the data. The residuals is what you're left with once you've taken all of the known effects out of the data. So for example, when we're trying to predict the population growth, if we take out the slope and the intercept, we're left with a bunch of noise around the slope and the intercept, and those would be called the residuals. So the noise around the predicted line or the best fit line, those would be the residuals. All right, so let's take a look and see what kind of model we might use to make our prediction. So I chose a SARIMA model, which stands for seasonal autoregressive integrated moving average model. So that's a mouthful, but it really represents two main effects. Effect number one is a trend element, and effect number two is a seasonal element. And if you look at the trend element, it can be described as how the model behaves from one point to another, and how each point might correlate to the prior point. And the seasonal element, instead of just looking at how points correlate from one point to another, or another point to another point, they'll be looking 12 months back. So what happened last year in January, or what happened last year in February. So if you're trying to predict January of a given year, it's going to look back to what happened in January of last year. Now, if you put a big enough set of parameters, you can look at the last 3 Januaries and say, well, if we know what happened in the last 3 Januaries, does that help us predict what's going to happen in January of this year? So the power of these models is that they're very good in a high noise environment at figuring out what's the most likely outcome for the next observation. And I'll describe this in a little bit of detail as we look at the results. So I pulled this nice little snippet of code. You'll see the reference here from the web to help plot the properties of the data. And what I have in here is the daily per capita production data. So this is the data that we looked at earlier, and that's the time series that goes up and then comes back down again. And I can look at statistical properties like the autocorrelation of one point to the next for different lags. So autocorrelation for one lag would be how January compares to December. Lag of 2 would be how January compares to November. Lag of 3 would be January to October, and so on. But you do that for every month. And so you're just looking 1 month before to today. What's the autocorrelation? And so we can see that it's 1.0 for a 0 look back, but then it's still 0.7 for a 1 look back, and it's still 0.5 for a 2 look back, and 0.3 for a 3 look back. And so that gives you an idea that there is some pattern to the data from one observation to the next. And another important element of time series analysis data is that it should be normal, or the residuals should be normally distributed. And what we see with this quarter over quarter plot, or quartile over quartile plot, and with this probability plot, which is very, very similar, is that you do indeed follow a normal distribution, which is the red line, pretty closely. So in this tail, you do have some points that diverge a little bit from the tail, a little bit here as well, but generally it's pretty nicely behaved, and the data does seem to be, for the most part, normally distributed, or the residuals of the data are. All right, and so if we produce this model, and here I defined a model by looking at a look back of 6 months. So I'm going to be using the 6 prior months to inform my forecast of the next month, and so that's my trend component. And then for my seasonal component, I'll be looking at 3 years of look back. So I'll be looking at the last 3 years to make my prediction. And we'll be doing a rolling window forecast. So we'll be looking at data 1 month incrementally at a time, and producing a new model and the forecast for each incremental month as we go. And so this is the snippet of code that produces these forecasts. I'm iterating through the data set and producing a forecast for the next 3 years, every month at a time. And if I run this code, I get an actual value that was produced, and I can compare it to the predicted value, and then compute the square of the error. And a root mean square error is a very typical way of understanding the magnitude of error that you have in your forecast. So I'm putting the square errors here so I can average them. And if we plot the time series data for the per capita production and look at it against the Sarima model, it doesn't look too bad. And so we have in red the actual values and in blue the predicted values. So of course it's not perfect because you're making a prediction into the future, but the general shape of it is kind of similar. So it goes up and down, and the prediction is like trending up here. In actuality, it didn't actually go up quite as much. And then here we're making a prediction it's going to go up significantly. It seems to overshoot that a little bit. And what these models tend to do, because they're statistical in nature, is they'll dampen the actual effect. So when in real life there's a big excess, well, the forecast is not going to be caught up in the euphoria of the moment. It's going to bring it down something closer to the average, but generally the direction seems to be about right, which is encouraging. Okay, so if we bring these things together and we take the per capita consumption with E raised to the log of the predicted population and multiply by the number of days in a month, then we should be able to get a total aggregate production number for every month. So let's see how we do when we do that. And so here we have our days per month coming back into the equation. So we take the predicted population with the predicted, so this is the predicted per capita production with a predicted population times the days per month and plot that result. And this is our aggregate original numbers, so the actual productions constructed from the combination of these two forecasts. And again, it's not perfect, but it's pretty darn good. And it gives us a pretty good idea of where production might be month by month, looking 3 years out. So this is one actual data point where we predict 3 years out, and it doesn't look too bad. So recapping then what we just did. So we started off with a problem, gathered data, did some analysis, went back and gathered more population data, brought it in, did some more analysis. We just produced 2 models, which gives us an overall model of what we expect the consumption or production to be. And then we get to a conclusion. And so we'll run one last quick poll.
Yeah.
Go ahead, Andrew, and run it for us.
Yeah, absolutely. And so I will now launch the poll. And to our attendees, please respond to the final poll. What factors would you explore next? And please select one of the following answers. And just a final reminder to our attendees to please post your questions for Dan in the chat box. We'll move on to our Q&A period after Dan's presentation. All right, I will now close the poll and I will now share the results. Dan, looks like 9% have want to explore demographics, 51% substitutes, 6% exports, 11% supply chain, and 23% economic cycles.
Very nice. All right, so obviously our crowd is very wise and you've had an opportunity to absorb this problem through the last 45 minutes. And I would probably go in the same direction as you, to be honest. And so that's a great place to be. But my goal for today was to really illustrate how data analysis is detective work. So you're trying to really understand the story of what's going on and why, and you develop theories. Some of them may be right, some of them may be wrong, but you go and get the data to prove out what you think. And then once you have uncovered sufficient data, you can really understand the problem and what's going on. Time series methods do produce a reasonable forecast for this type of problem. There's other techniques that are available, like artificial intelligence or machine learning, and those will definitely provide a different approach to this problem and produce good results as well. But this is an oldie but a goodie. It's a method that's been around for some time and produces very good results in noisy environments. But the insights that we did get out of today, besides understanding the process, are that beer production is seasonal. Australian beer production has flattened since 1980. Per capita consumption has actually declined since a peak of 1975. And if you had had these techniques available, you probably would have caught the per capita trend in the late 70s. And that would certainly be useful if you're employed by a beer company. So I'll leave it at that, and I'm happy to take any questions that you might have.
Great. Well, thank you so much, Dan. It's been incredibly informative, and I think we definitely appreciate that. So we'll move on now to the question and answer period. Looks like we have a few questions here, and we'll start with a couple of questions, but one in particular from Gary, who basically asks, at what point does it make sense to maybe become more hands-on with tools like Python? Versus becoming maybe more adept with Excel?
That's a great question. So I went through that dilemma myself about 10 years ago. So I knew nothing about Python, but I was suddenly working for a firm that was generating more than 1 million lines of data per day. And I had no choice in the matter at that point. If I wanted to know what was going on with our trading activity, I needed a tool more powerful than Excel. And I quickly realized as I was playing with Python that, oh my, it's much more robust if you're able to write a piece of code where you test every piece that you write, make sure that it's of good quality, and then build on top of that. So it's a layered approach where you have a foundation and you just put stuff on top of it. And the code is so much more powerful than an Excel spreadsheet that it becomes pretty clear that that's what you need. Now, Excel has its place. I'm still a very avid user of Excel and I use it as much as I can. But for anything that is either more complex than a straight linear regression, anything that's more data intensive than the 1 million lines that Excel is capped at, Python becomes a great tool. And if you're a young professional just starting your career today and you're going to be playing with data in a meaningful way, I think Python is a great tool to learn.
Yeah, great. And I guess, Gary then asks, kind of speaking, I guess, to the limitations of Excel. So I guess at what point is it just the mass quantity of data you're dealing with, or is it maybe kind of the actual concept itself? So maybe, because it seems like there's a couple of questions here with people really just kind of asking that particular idea, Dan. So I guess really kind of any insight that you can give to really just anyone interested in what's dealing with data in general.
Yeah, so if you look at Excel in general, it's a great tool for presenting data. It's also a very good tool for making calculations that are relatively simple. If you start doing anything more complicated in Excel and share it with someone else, it becomes very difficult to decipher which cells refer to what and what's the exact math or logic that the creator used. The beauty of code is that well-written code is very legible. And so it's easier to share with other users what you've actually created. And the other beauty is that it's more robust. So if someone goes into your Excel spreadsheet and screws something up, the Excel will still present something, but it could be dead wrong. With code, if you go and change the code on someone, something will probably break. And when something breaks, you realize, oh, someone's done something with my code. I should really pay attention to this. So generally, if you're doing anything that's going to be used by other people, using lots of data, so more than 1 million lines, using sophisticated math or logic, you probably want a piece of code to do that.
Well, great. Well, thank you so much for that insight, Dan. I think definitely appreciate it myself and as well as others. And kind of along the same lines, we have a question here from Edward who asks, do you prefer Python over R as an analytical tool? And maybe, I don't know, maybe some maybe some of your experiences with maybe, one or the either, and maybe the advantages, disadvantages of one or the other. Yeah.
Sure. So I haven't used R as much as I have Python. Generally, my sense of R is that it's a very good tool for reading in data, doing some quick statistical analysis on the data, and producing plots and producing insights, or even developing a model off of that data. But it's not a great programming language. And Python, over the last few years, has caught up in terms of statistical tool capability. And so Python, I would say, is probably just as good as R today for those uses. But what Python is also good for is as a programming language. So you can actually write big pieces of code in Python and have it be very legible and have a lot of functionality that would not be available in R. And so the main advantage of R has kind of gone away in my mind, and I believe Python is in a better place. But if you're accustomed to R and you're comfortable with R, it's a fantastic tool. You're able to run, very good analyses very efficiently. Andrew, any other
Great, awesome.
questions?
Yeah. Great. Just going to the questions here, and kind of, from your experience, how does your balance, how do you balance sort of the insights from data forecasts and maybe insights from your own industry knowledge and maybe intuition? So maybe you can kind of speak on that.
Right. Well, generally speaking, it's hard to do any kind of data analysis in something you know nothing about. And so you want to be a domain expert or become as good in the domain that you're working in as you can if you're going to be developing forecasts or developing models. And so there's no substitute for understanding the logic behind the data to then be able to do something with it. And hopefully this came through today, because as we were looking at beer production data, like we can all relate to beer because we've all seen it or drunk it or enjoyed it in some shape or form. But the reasoning of what's going on behind beer production, like there's only so many things that could be going on there. And we were able to discuss those as a group and act on it by gathering more data and coming up with hypotheses and testing those. You can imagine that if you're working, for example, for a credit card company and you're trying to predict defaults. Well, if you're trying to predict defaults, you need some good consumer credit information. You need prior patterns of spending and ability to pay in order to build a good credit model. And if you're working in meteorology, it probably helps to know something about what drives weather, what the prevailing winds are, and understanding the effects that are relevant behind it. So domain expertise comes with working in an industry or getting training as an expert in an area. What we focused on today was more a methodology that can then be applied to whatever domain you happen to be operating in.
Great. And it seems like a lot of people here are just like, they're kind of different levels, maybe kind of entry level or maybe in the middle of their career. So what sort of advice do you have to individuals that might be in the middle of their career, but maybe don't have like the exact education for maybe data science or just kind of looking at sort of big data per se?
So that's kind of what I faced about 10 years ago. So I was in the middle of my career. I was a startup CEO and then became the leader of a startup that had a very data intensive business. And I wanted to get my fingers in the data because that was key to the firm's growth and profitability. And so there's a lot of tools available online to learn these skills. Certainly when you go about it as a self-learner, it's a very big lift to have the discipline to bring all of this to bear. I would encourage you to definitely use whatever online resources you can find. But if you can find a program somewhere where you can sign up either at a community college or at a place like Santa Clara and take classes that then give you a guided framework for going through the journey of learning, then that might be a more efficient way to do it. Because interaction is an important part of learning. And when you're exposed to how other people are absorbing things, I find that to be extremely helpful.
Yeah, we definitely appreciate that insight there. And I guess we have a final question here. And obviously, when you're dealing with analysis and you're dealing with data, and whether the content you know beforehand or not, how do you kind of guard against personal bias before starting the analysis? I.e., maybe knowing the answer before the analysis.
Well, I think that's the difference between a data analyst and a pundit. If you're a pundit, then you're making a prediction and you may or may not have a good basis for making that prediction. But if you're a data scientist, you're going to make a prediction, have a hypothesis, and then test it. And I would say 90% of the hypotheses I've ever had in a data science problem have been wrong. It just so happened that today I showed you something that worked out pretty nicely, but in real life, almost everything that you guess at is wrong. And so you make a lot of mistakes, you spend a lot of time wasting time, and then eventually you find a nugget and you go, whoa, this is great, let me use that. And so that aha moment, the detective work, that's really what is the exciting part of data science.
Yeah. Well, great. Well, I think we're going to draw things to a close, Dan. I just wanted to say thank you so much again for a thorough presentation. Obviously a lot of great takeaways here. And Dan, I'll leave it to you for any final words before I sign off here.
Yeah, well, I'd like to thank everyone for coming today. I think it was great to have the interaction, and I was certainly impressed by the answers you gave in the poll. If any of you have an interest in learning about programs where you can pick up these skills, we have a wonderful program with our MS in Business Analytics where we combine business skills with data science. And so you're getting that nice mix of being able to ask the right questions, but armed with the tools to figure this stuff out. And it's a 15-month program. It can be done part-time, and it's right here in the middle of Silicon Valley. So it puts you in a great place to then find a job for the skills that you pick up. So thanks again for your time, and I'd love to talk to any of you if you have questions.
Great. Well, thank you again, Dan, and thank you to all of you attendees who joined us today, and wherever you may be in the world. I hope you have a wonderful rest of your day. Thank you.